Picture this. You're sitting across from a financial professional and they start explaining a fixed indexed annuity to you. Things are going great. Principal protection, growth potential, guaranteed income for life. You're nodding your head. And then they say two words that make you stop cold. Surrender period. And just like that, your mind goes to the worst place. Wait, you mean my money is locked up? What if I need it? What if there's an emergency? What if something changes? I get it. That reaction is completely normal. And today, I'm going to give you the honest, no fluff truth about surrender periods, what they really are, what protections you actually have, and why, for the right person with the right money, a surrender period might not be a problem at all. I'm Shonda Prescott with Retirement Security Simplified, and this is one of the most important conversations we can have about your retirement money. Let's get into it. Let's start at the beginning, because a lot of the fear around surrender periods comes from not fully understanding what they are. A surrender period is simply the length of time you agree to keep your money in an annuity contract before you can withdraw the entire balance without paying a penalty. That's it. It's a commitment period, similar in concept to a certificate of deposit or even a mortgage. You agree to a term, and in exchange, you receive benefits that wouldn't be possible without that commitment. Now, surrender periods vary depending on the product. Some are as short as 5 years, others are 7 years, 10 years, or in some cases even longer. The length of the surrender period is usually tied directly to the level of benefits the contract offers. And here's how the penalty works if you do withdraw more than you're allowed during that period. Let's say you have a 10-year contract. In year 1, the surrender charge might be 10%. In year 2, it drops to 9%, year 3, 8%, and so on, decreasing by 1% each year until it reaches 0 at the end of the surrender period. So the penalty is highest at the start and gradually disappears over time. Now, and this is critical, that surrender charge only applies to amounts you withdraw above what the contract allows. And that brings me to the part most people have never been told. Here's where things get really interesting and where a lot of misconceptions fall apart. Most people assume when you put money into a fixed indexed annuity, it's completely frozen, untouchable, like it disappears into a vault and you can't see it again until the surrender period is over. That's not how it works. The vast majority of fixed index annuities have what's called a free withdrawal provision built right into the contract. This means that every single year you can withdraw a percentage of your account value, typically 10%, with absolutely no surrender charge, none. So if you have $300,000 in your annuity, you can withdraw up to $30,000 in a given year without triggering any penalty whatsoever. But it goes even further than that. Most quality fixed indexed annuity or FIA contracts also include provisions that waive surrender charges entirely in specific hardship situations. These are called waiver provisions, and they commonly cover things like nursing home confinement. If you or your spouse enters a qualified nursing facility, many contracts will waive the surrender charge so you can access your money without penalty. Terminal illness. If you're diagnosed with a terminal illness, most carriers will waive the charge entirely, because the last thing you need in that moment is a financial penalty standing between you and your own money. Death of the contract owner. In the event of the owner's death, surrender charges are typically waived for the beneficiary as well. And here's one more that matters a great deal for people over age 73. If you're subject to required minimum distributions from a qualified account, like a traditional IRA or a rollover IRA, most carriers will accommodate those required minimum distributions, or RMDs, without triggering a surrender charge. So let me say this clearly. The money is not frozen. It's structured, and there's a very big difference between those two things. Now, let's talk about the why. Because once you understand why surrender periods exist, they stop feeling like a trap and start feeling like a trade-off, and a pretty good one at that. Here's the reality. When an insurance company issues a fixed indexed annuity, they're making serious promises to you. They're promising that your principal is 100% protected from market losses. They're promising that your account has the potential to grow based on a market index without you ever losing a dime when the market goes down. And if you add an income rider, they're promising to pay you a guaranteed income for the rest of your life, no matter how long you live, no matter what the market does. Those are powerful guarantees. And to keep those promises, the insurance company needs to invest your premium into long-term instruments, primarily bonds and other fixed income assets. Those investments take time to mature and generate the returns needed to back up everything they've committed to you. The surrender period is what makes all of that possible. It gives the insurance company the stability they need to make guarantees that banks and brokerage firms simply cannot offer. Think about it this way. When you take out a 30-year mortgage, you're committing to a payment schedule in exchange for a locked-in interest rate and the ability to own a home you couldn't pay for outright. The commitment is what creates the benefit. A surrender period works the same way. Now, let's compare this to a CD for a moment, because I hear this comparison all the time. CDs also have early withdrawal penalties. In many cases, if you break a CD early, you lose months, sometimes even an entire year, of interest. And what do you get in exchange for that commitment? A fixed rate that rarely keeps pace with inflation. No growth tied to a market index, no income guarantees, no principal protection beyond FDIC limits. With a fixed index annuity, you get the 10% annual free withdrawal I mentioned earlier, plus the potential for significantly higher growth and benefits that no bank product can match. When you look at it side by side, the trade-off starts to look a lot more favorable. Now, I want to be completely straightforward with you here, because this is the part that separates good financial education from a sales pitch. Surrender periods are not right for everyone, or more accurately, they're not right for every dollar you have. Let me explain who this makes sense for. A surrender period works well if the money you're placing into an annuity is what I call safe money. Funds you've already mentally set aside for the long term. Money that is not serving as your emergency reserve. Money that you don't have an immediate plan to spend in the next year or two. Funds that you want working for you in a protected, structured way. For pre-retirees and retirees who have a pension, Social Security income, or other reliable cash flow coming in, and who have a separate liquid emergency fund, placing a portion of their savings into a fixed index annuity with a surrender period is an entirely reasonable decision. Now, here's who it's not right for. If the money you're considering is your emergency fund, stop right there. That money needs to stay completely liquid in a savings account, a money market, somewhere you can get to it the moment you need it. If you know you have a major expense coming up, a home renovation, a medical procedure, helping a family member, that money should not go into a surrender period product. And if the time horizon of the surrender period extends well beyond a point that's realistic for your life plan, then that particular product may not be the right fit, even if the concept itself is sound. Here is the honest truth. A surrender period is only a problem if the wrong money goes into the wrong product. Smart retirement planning means matching right financial tools to the right purpose. Before you ever sign an annuity application, there are 5 questions you should ask, and any reputable agent should be able to answer all of them clearly and without hesitation. Question 1. What is the free withdrawal percentage and how is it calculated? Make sure you understand exactly how much you can access each year without penalty. Question 2. Does this contract include a nursing home waiver, terminal illness waiver, or both? Know your hardship protections before you commit. Question 3. How does the surrender charge schedule decrease over time? You want to see that it's stepping down each year, and you want to know exactly when it reaches zero. Question 4. What am I receiving in exchange for this commitment? Principal protection, index-linked growth potential, a lifetime income rider? The benefits should clearly justify the structure. And question 5. Is this money I've already designated as long-term safe money? If the honest answer is yes, a surrender period is simply the mechanism that makes the benefits possible. If the answer is no, or if you're not sure, then more planning needs to happen before any money moves. If those 5 questions have solid answers, the surrender period is not a flaw, it's a feature. Here's what I want you to take away from this video. Surrender periods get a bad reputation, and most of the time that reputation is built on incomplete information. The money is not locked in a vault. You have access to a portion of it every year. You have hardship protections built into most quality contracts, and the surrender period itself is the very reason the insurance company can make guarantees to you that no bank account, no CD, no brokerage account can match. When the right money goes into the right product for the right reasons, a surrender period is not something to fear. It's simply the structure that makes your protection and your guarantees possible. If this video helped you, please get the free booklet called For Those Who Want to Prosper and Thrive in Retirement. Check out the link in the description box to get that information. This is Retirement Security Simplified, where we specialize in turning confusion into confidence, one conversation at a time.